Hello, and thanks for joining me for Phil Spencer's latest insider guide to all things property related. Today, I want to take you through all the reasons why it might not be a good idea to pay off your mortgage early. Now, for many homeowners, being mortgage-free as early as possible might seem like a wise financial decision, but there are some drawbacks that you might not have considered. Number one, when you pay off your mortgage early, you're essentially tying up a large portion of your savings in your home. So while you won't be forking out monthly mortgage repayments, it limits your access to available cash in case of emergencies. By all means, pay off your mortgage, but make sure you still have enough in savings to cover unexpected costs. The second thing to consider is whether paying off your mortgage is the smartest investment you could make. Are there other financial opportunities that could potentially net you higher returns? Make sure that you're not potentially limiting your investment growth. And remember the flexibility that some mortgages offer. Useful financial flexibility like variable repayment schedules, interest-only payments, and payment holidays. By paying off your mortgage early, you lose access to these features that could be helpful if your financial situation changes or you need to free up some cash. Another disadvantage to factor in when you're doing your sums is whether you'll get hit by your lender's early repayment charges. These are essentially a penalty for getting out of your mortgage agreement early, and they can be substantial enough to offset the potential savings from repaying your mortgage. Whilst owning your home outright seems like a no-brainer in terms of your credit score, it doesn't always work like that. Whether it's a disadvantage for you is something that's worth looking into, as your credit score depends on multiple factors, including managing credit and your payment history. But if you do want to reduce your mortgage, there are some options I suggest you investigate. One of the simplest is to increase your monthly payments. By paying more than the required amount each month, you can significantly reduce the term of your mortgage and save on interest payments. Do, however, check with your lender to make sure there aren't any restrictions on extra payments. If you are free to overpay, you could use any bonuses, inheritance, or other windfall to pay down a portion of your mortgage. Another option is to switch to an offset mortgage. This is a mortgage that is linked to a savings account. Whatever is in the linked savings account is used to offset the mortgage balance, effectively reducing the amount of interest you pay on your mortgage. By depositing extra funds into the linked savings account, you can reduce your mortgage balance and pay off your mortgage early. Before you make any switch, speak to your mortgage advisor, who will be able to talk you through the detail and look at your options. There's a link with this episode that will connect you with our panel of approved advisors, so you can find someone experienced to talk to. You might want to discuss switching to a shorter term, like a 15-year mortgage. By reducing the term of your loan, you could potentially secure a lower interest rate. Bear in mind that remortgaging may come with fees, so it's important to weigh the costs against the potential savings. So, as long as you know the potential downsides of paying off your mortgage, you can make the right decision for your personal and financial situation and your long-term goals. If you want more insider advice like this, make sure you're subscribed to this channel and hit the alert bell to join me next time.